We continue with our discussion on financial reporting and analysis, and in this particular section, after having introduced to the idea of what financial statements are and what is the need for accounting, we're going to look at what are the three main activities or classifications of activities that any business does, right? So any business, any activity that they do can be broadly classified into three different parts, right? What are those three parts that we're going to look at, right? So we're going to kind of create a classification of business activities. Every activity will get classified into these three different kinds of activities. We'll also try and understand the purpose of classification of these business activities, right? So any business activity can be classified into either what is called as operating activity or what is called as investing activity or what is known as a financing activity. Either one of these three is what is going to form the crux of any activity that the business does, whether they purchase raw material, whether they sell something, whether they raise some loan, whether they pay an interest, whether they go and borrow money, whether they go and pay salary to someone. Everything is going to be a part of a business activity. It is going to get classified as a business activity, right? And it will get classified in one of these three. It cannot go outside these three. What is the purpose of classification of these business activities? It makes us easier to analyze what the firm is doing, both on an operating level. Is the firm actually investing in future growth? Are they operationally making money, right? Operationally, how's the performance on an operational level? And where is the money coming from? So what is the source of money for the firm? Once we divide this into these three parts, it basically gives us an idea on whether the company is operationally doing well, whether the company is able to invest some part of the money for future growth, and whether the company is raising money from a bank or somewhere else. So what is the source of the company to manage that money and raise that money, and how does the company repay that money, right? It makes it easier to analyze all activities of a business once you classify them. It also gives you a purpose on why a certain activity is happening, right? So if you are paying interest on something, why are you paying interest? Is because you have already borrowed some money there. So the payment of interest is essentially some sort of a financing activity in that context, right? Now, some of these are a little bit fuzzy. When I say fuzzy, they are unclear as to whether you can clearly classify them into one area or the other, but we will take those separately at a later point of time. We'll create those special cases separately, because in certain cases it could get classified in two different areas, right? We will look at those examples as we go along, but most of them otherwise are fairly simple to classify in either operating, investing, or financing once we understand what is each of them, right? So let's understand what each of them are, right? Remember, these operating activities are also incidental to what entity is doing that. What is the company that we are looking at? So activities that are part of day-to-day business functioning of an entity, right? The operations of business. And it depends on the company and the industry you're looking at. How? Let's take an example. If there's a restaurant that is selling some meals, that sales of meals is basically what is going to be an operating activity for them. Sale of services by a consulting firm is going to be an operating activity. Sale of ovens by an oven manufacturing firm is going to be an operating activity, right? Expenses that you have taken for all these three, right? Like employing people, taking raw materials, etc. All those are also going to be operating activities, right? Now think of it, there is a company that raises money from a bank. So the bank gives money to the company, right? That's a loan that is given. If you're looking at the company, raising money is not an operating activity. It'll get classified somewhere else. But what if we are looking at the bank? What is the business for the bank? Taking money in the form of deposits, right? And giving out money in the form of loans is day-to-day activity for a bank. So from the bank's perspective, this is operational activity, right? So by a bank taking deposits and making loans is an operational activity. And that's why I said that it depends on what is the industry and what is the business that you're looking at. For another company, taking a loan may not be their core operation, right? But for a bank, taking money and giving money is their core operation. So always remember that when you look at the functioning of a company, what is their day-to-day business activity, right? What is their day-to-day business? Any activity related to that is your operating activity. So it's simple to say that if I'm doing a business of consulting, my day-to-day activity in terms of consulting someone, raising money, getting money because of sale of services there, or paying salary to my employees are both operating activities for me, right? Whatever is a day-to-day activity for a business is part of operating activities for that company, right? Then we move on to the next one, which is investing activities. Typically, activities associated with acquisition, which is buying, and disposal, which is selling of long-term assets. It may sometimes also be there for short-term cash, right? But largely, in only in specific situations this comes in. Otherwise, largely we are focused on long-term assets here. Everything else otherwise goes in the context of uh, your financing activity otherwise, right? Now, when you look at long-term assets, what are long-term assets? So purchase of equipment. When we say equipment, long-term equipment in the form of factory, machinery, etc., right? Now, let's say a restaurant goes and buys surplus equipment. You bought more than what was needed. If you sell that, the sale of that is also considered investing activity, right? If you go and buy another company, right? If you buy another company, that is also effectively buying factories of that company, right? Buying the land of that company, buying the machinery of that company. So all that also falls under investing activities. Typically, your investing activities are going to fund the future growth of the company, right? What is going to happen in the future is going to get funded by the investing activity, right? So in long-term nature, you use the money, you go and buy some sort of assets, you go and create capacity and all those areas as you kind of go along. That's where future activities are going to come in, and that's where future growth is going to come in from. That is all what is called as investing activities, right? Now, let's come to the third one, which is if you go and look at getting money or paying money, so obtaining or repaying capital. In other words, money for the business. If you are raising money or repaying that money, all that falls under what is called as financing, because you're effectively financing your business, right? So issuing shares, right? We'll discuss more about this as we go along, but basically giving ownership of the company to someone else by issuing what is called as shares, taking out a bank loan, right? When we say taking out a bank loan, we are basically saying that you are going to a bank and borrowing money from a bank. You're going to the bank and saying, please give me some money so that I can run my business, right? Issuing bonds, right? Which is bonds are kind of borrowings only, but just that instead of a bank, you're not going to a bank, you're going to either individual investors or you are going to some fund manager, right? If you raise money from a bank, that's a loan. If the same loan, however, gets taken from some individual investors or fund managers, that is called as a bond. But it is nevertheless a money raising activity. More about bonds at a later point of time in probably some other subject. We don't necessarily need to kind of bother too much about bonds at this point. But any kind of activity that raises money for the business in terms of obtaining or repaying capital, raises money and then repaying that money that you have raised, is going to be a part of financing activities. If you give back the money to these guys from where you have taken the money, that's also financing activity, right? So broadly, we have divided the contours of all the three activities that any company can either take money, use that money, run the business, return that money. That's the only three, four things a company can do. right? You can use the money for either running the day-to-day activities of the business, or you can use the money to kind of fund future growth of the business. Depending on what you are doing, everything will get classified into these three activities, right? How are these business activities related to elements of financial statements, right? So let's understand. This is a business. It can raise money, right? And then it can use money. The money can be used in two parts. It could be used in future growth, and it could be used in day-to-day activity, right? Day-to-day activity, whatever the company does, is operational activity, right? Future growth, whatever the company does, is investing activity. Raising money, and then eventually you may get money from your day-to-day activity, or you can get money from your future growth. Returning that money is going to be your financing activity, right? Assets are nothing but economic resources that the company has. We will discuss more about assets, liabilities, and owner's equity in a minute. In a few moments in the next section that we come to. Assets are any resources that the company owns, right? Factory, machinery, raw materials, cash. These are all economic resources for the company. Liabilities are claims of guys, right? Banks might come to us and say, please give our money back. Individual investors who have given us money in the form of bonds may come back and say, please give our money back. Owner's equity is essentially any business has an owner. An owner can give money to a business. That's called a residual claim. What is a residual claim? You make a profit. From the profit, you first pay the lenders. Remember, the banks always come first. And then if something is left, that goes to the owners, right? That's why it's called residual. Only if there is a residual after repaying the lenders is when you will get money as the owner, right? Revenue, inflows of economic resources. Revenue is nothing but sales. If I'm a car manufacturing company, when I sell a car, that is when revenue comes in. Expenses are outflows of economic resources, right? Basically, I pay money and I get some sort of a product or service in response to that. That is going to be my expenses. So business activities are going to get related to these areas, right? Let's take some examples. A company manufactures cars and sells them. Where will this come? Will it be operating? Will it be investing? Or will it be financing? This is a day-to-day activity for a firm. So this is going to be an operating activity for the firm. Company buys a new factory. When you buy a new factory, this is for funding future growth. Future growth would mean investing activity. It's a long-term asset that you're buying, right? Company buys raw materials for manufacturing cars. That's an expense, correct? That's an expense that you have. Expense under the operating segment, because that's again a day-to-day activity for a firm. This is a revenue. This is an investment in the sense, right? Or you're creating what is called as an asset here. Right? Company borrows money from banks for this factory, right? That's a liability, correct? But you are borrowing money, that means it must be a financing activity. Then company pays interest on the money borrowed from the bank. This we will take in a minute. This is interesting because this can get classified in two places. Company ends up selling the factory at some point. You are repaying the liability, right? You're repaying a liability, but you are trying to repay the liability by first selling something that is extra for you. So in a sense, you're removing an investment from your book. This is again going to be an investing activity because you are selling the factory to repay the money. So you're removing assets from your company's financial statements, right? Now, when you borrow money from a bank, if you pay it technically to a bank, then it is safe to classify it as a financing activity. There's nothing wrong with that. But under some principles, let's say you have borrowed money for the factory building, right? Let's say the factory costs 100 crore and you take a loan of 100 crore for building that factory and you pay an interest of 10 crore on that loan, right? Now this loan was taken because you were building a factory, right? This loan was not taken because you generally wanted to raise some money, but because you were building a factory. So in certain cases, you could also classify this either because it's your investing activity, so as a part of the investing activity, or if you're taking a loan to run day-to-day operations, then some of these paying interest could also get classified as operating activity. However, it is safer to kind of put it as the financing activity, keeps things simple, keeps things kind of comparable across all firms, right? That's the classification of business activities. That's where we end this particular section. A question before we end: what are the various classifications of business activities? Explain each of these with some examples. Thank you.